Hi there, my name is Glenn and this will be my financial analysis presentation. So to begin off with is the basic process I went through. I looked at all the companies on Bloomberg and I kind of checked the cash flows real quick. I was looking at the balance and income sheets and I was looking to see if there were any companies that were obviously selling off fixed assets to make a profit, which is kind of a sign of almost a fire sale going off in the company and making profits that won't really last and really signals that the company might be in a decline. The other thing I was looking for was just people taking out debt just to cover interest. I saw a lot of companies taking out a lot of debt, but my belief was that debt was just to finance themselves in the future. And after that, I used a couple different ratios to analyze the company. The ratios I chose were searching for companies with good operations, companies that were safe, they weren't gonna fall into debt and they're gonna be able to cover their interest, and companies with decent liquidity so they can react to the markets. And basically I was thinking about this project that if I wanted a safe portfolio that I could put a company in and just let it sit and slowly grow over time, which companies would I feel the safest with to kind of sit in that portfolio. And we're looking at 3 industries, 5 companies per industry, and I had to pick the favorite one and then my number one overall. So to start off with, I was looking at hotels. We had Marriott, Hyatt, La Quinta, Hilton, and Wynn Resorts Limited. So the first ratio I started off with was the current ratio. They usually like the ratio to be between 1 and 2 because that shows good liquidity. It gives you enough room to move around. But depending on the industry, you really just want to look at a company with a liquidity ratio that's kind of better than the industry average. And when we're looking at liquidity, all of them had kind of decent ones. The ones that were low were definitely La Quinta and Marriott. The interesting thing about Marriott is even though its current ratio wasn't that impressive, and then a lot of the other ratios, they look like a really strong company, but if the market changes drastically, they don't have quite the wiggle room the other ones have. And the rest of the trends was everyone was kind of going with the red line, the industry average. The only real improvement you saw in the current ratio is Hyatt, and they had a nice little up and down, but the last couple years they've been building it back up. The one that's most worrisome here is definitely La Quinta. They start out really low, and right now they're hovering a little bit above 1, which is a lot better than they start out with, but they might still be in rocky waters. The next ratio, which I found really important, and from trying to be a safe investor, interest coverage is probably my favorite ratio because I just want to see if companies can cover their debt and cover it by a decent amount. Because the last thing you want to see is interest just creeping up on a company and taking them out of business, because then your investment is worth nothing. So when it comes to interest coverage, everyone in the industry is doing pretty well. La Quinta, like with the current ratio, is kind of the low one in this industry also. Marriott has an extremely high interest coverage ratio compared to everyone else. The ratio definitely does not have to be that high, but definitely having, you definitely want above 1. 2 makes you feel really safe, which at the end here, everyone except Wynn and La Quinta was below or above 2. And next, what we learned in ROE decomposition is that when it comes to ROE, the best measures of management is operating margin and asset turnover, because those are the parts of ROE that are completely in control. So when wanting to see how companies manage operations, I definitely want to look at the operating margin and asset turnover, because that's going to be a good representation of their management. And as we see here, we have Wynn start out really high, they had a drop, but then they've been improving. And if you look at the industry, most of them followed the industry trend with improvement over the last couple years in operating margin. So the hotel industry as a whole definitely looks like a good one to invest in, because the operating margins are continuing to grow up. I'd say in this industry, it's really good to see the upward trends. And probably the most impressive company in this industry, it looks bad for Wynn to have that huge drop in operating margin, because you see that huge decline, but they're still far and away in the industry the highest operating margin. Their low point, they were still the second highest operating margin in the industry. And when it comes to asset turnover, there's Marriott, which is by far the highest of the group. The not so good thing about it is you see how they did so good here, but then they start dropping down to the industry average. Where the better thing to see is, say, Hilton and Wynn Industries, to see how they've, over the last couple years, have been steadily improving their asset turnover. Where Marriott, it's amazing they had it up all the way up here, but you just see the drop continue to happen. And then the next thing is to look at valuation. I looked at last price, which kind of shows how they're doing in the market. And the thing I always think is the market's always gonna end up being right. The market's just gonna be slow to catch up sometimes. And then I like looking at enterprise value, which is the takeover price. And you just really want to see companies that are doing actions that the market notices for the last price to continue increasing it. And you really want to see the companies take actions that are improving its company's value, because you want to buy in at these companies as they're building up their value so you can make money. And if you look here, Marriott has really increased its value in a pretty impressive manner. The other one is Wynn. You've seen the trend throughout all these ratios. You kind of see them go down to 2015, but then you've just seen a nice improvement in all their ratios. And they also, in 2013 when they started out, even with this decline to 2015, they were still good, barely below the industry average, and they just build themselves back up. And then when it comes to the stock price, you see they start out the highest, and they did their drop, but they've built themselves back up to be the highest price again, which is the same thing they did in operating margin. So when it comes to the value and the operations, you see Wynn just improving in everything, and that's why I chose them as my favorite company in the hotel industry. It was close between them and Marriott. I just noticed the downward trend in Marriott in the asset turnover, even though it was really impressive and the highest in the industry. Also, their current ratio was not impressive, but Wynn they were impressive in all the ratios. They were trending upwards in everything, and they were just the best in operating margin and last price, and it kind of made them the easy choice for me to choose them as my favorite in the industry. The next industry I looked at was tech hardware with Advanced Micro Devices, NVIDIA, Micron Technologies, and HP Inc., and also Cognizant. So when looking at the liquidity in this industry, there's only one company that does not have the greatest current ratio, but even then, it's not even that bad. They still have it over 1, and they barely dip below 1, and that was HP. Everyone else is definitely in decent shape, and they can definitely react to the market. The one that is really impressive, and the one that's going to be impressive throughout, is definitely NVIDIA. You see, since 2015, NVIDIA's current ratio has just gone up. They have been extremely successful, especially compared to the industry. Next is, again, interest coverage. Definitely my favorite ratio to know just if investment is safe. And this is when AMD definitely looks kind of scary. Because you see, they actually had a dip into the negatives to -3 in 2015. And they're the only company in the industry that looks kind of scary in their interest coverage ratio. The other one is Micron. They definitely had a dip to 0.38, but then they hopped right back up to their normal, which is around 10. But everyone in this industry is in a decently safe space when it comes to their interest coverage. So now it comes to look at operations, and you see upward trends in almost the whole industry for operating margin. The only exceptions are HP and Cognizant. Everyone else over the last 2 years have seen a nice upward trend in operating margin, which makes me think that this industry is on an upward slope, along with the economy also just being in the upward slope over the last couple of years. And then we look at asset turnover, where AMD actually shines in this one with one of the highest. It's nice to see all the improvement. The only one without extreme improvement in asset turnover is Cognizant, but their numbers are still really strong. No one here has like a terrible number in this, so you can say all the companies have a pretty strong asset turnover. And then when it comes to look at the valuation between them, it becomes really apparent that NVIDIA is leading the pack with no real other competition. Over the past, really, since 2015, so past 3 years, they've just been killing the competition. I'd say the industry as a whole is steadily improving. It's worrisome to see how HP has fallen in the enterprise valuation, but besides that, none of the companies are a terrible investment. Just AMD, with their current ratio not being the highest and their interest coverage ratio being low, they're the scariest investment, but none of them are exceptionally bad investments. It's mainly just NVIDIA is making everyone look bad, which is why I chose NVIDIA as my favorite company in that industry. They have good management, best operating margin, and they're improving their asset turnover. They're well funded, no worries about financing, they're safe from debt, and really just their skyrocketing valuations. The only downside I have with NVIDIA is they've improved so much in everything that it might be almost too late to invest. You still see everything trending upwards, so it's still definitely a good investment. It's just how much more can they continue to keep improving? And if they, with their improvements, if they're going to end up being overvalued. So the thing with NVIDIA, the best time to invest was definitely a couple of years ago, but they still look like a pretty safe investment. The last industry I'm looking at is satellite and cable communications. I look at the big guys, Comcast, Time Warner, AT&T, and Dish, and then a not so big guy, Laurel Space and Communications. So when look at liquidity, everyone kind of stays around the industry average. Time Warner has a really impressive liquidity. They kind of stay around 1.5 consistently. Comcast and AT&T have kind of a lower one, and Dish has a pretty good one also. They had a down year in 2015, but they went right back up in the later years, and then actually down again in 2017. So they kind of have a little up and down here, but overall their current ratio is still pretty good. Laurel, you can definitely tell that at the end here they kind of throw off the industry average because they just got a bunch of capital to try and make decisions with. So when looking at the interest coverage, you have Laurel here. They have so much investment going on, they have so much debt, they can't cover their interest, and they kind of throw off the average. People are really hoping that Laurel will eventually make really big profits, but right now they're not like the other companies in this industry, and they're not already established and making profits. They just have a lot of capital in them, and they're trying to get to a point where they can make steady profits. And everyone else in this industry is really safe with interest coverage. We have a lot of 5s and 4s, and Dish is a little bit lower with 1s and 2s, but they're still really high compared to what they need to be for interest coverage. So no one in here except Laurel is really worrisome, and they're just worrisome if they can never make a profit. And if you look at operating margin for the industry, we're seeing a lot of consistency. AT&T and Dish are definitely up and down, but you see Comcast and Time Warner with nice consistent top lines leading the industry. So you definitely worry about Dish and AT&T if they can trend in the right directions, because during the past year they each went down, where Time Warner and Comcast are still kind of up here at the top. And so if you want consistency, Comcast is looking really good here. It's almost like they try and hit 21 every year, like it's their goal for operating margin. Time Warner had a nice increase, and they actually just have a really good operating margin. And then the next is looking at asset turnover. The biggest worry here is probably with Dish. It's definitely, they had a nice lead when it came to the other companies in the industry, and it's just been slowly declining. AT&T is also in decline, but Comcast and Time Warner are doing a nice increase. And then when it comes to the valuation, so if we look here at the enterprise value, you see AT&T had a really nice increase, but then they're going down. And everyone else is kind of steady. What I like the most when I was kind of looking at this trend over time is really throughout all the different ratios we're looking at, Comcast was just a steady improvement, or they were consistent. So they just looked like a really safe investment. Even though you probably won't be getting that much return for it, you won't be losing your money. And you kind of see that in the last price. They actually started out low, but it's just been a steady increase throughout. And Time Warner, you had that nice big increase from 2015 to 2016, but I believe a lot of that was the talk of them being bought out, creating a lot of hype for that company. So I believe that was not a true measure of their market value. It was just because people were thinking they're going to get bought out, where Comcast has just been consistently moving up over the past 5 years. So in that industry, my favorite one was definitely Comcast. It was slow growth, but it was consistent growth in all the ratios I found important. It looked safe. Their operating margin, I believe, is always going to be around 21. And they had the biggest gain in enterprise value over the last 2 years, and it still looks to be trending upwards. Lastly, I'll choose my favorite one overall. It was definitely NVIDIA. They've had extremely success. They're increasing in all the ratios I find important. They definitely have good management. They're definitely safe from debt. And their valuation is skyrocketing. Like I said earlier, though, the only downside is it's definitely too late to cash in on their dramatic improvement, but it's not too late to, I believe, will be a continued improvement. Thank you for watching, and this was my finance presentation. Thank you.